Welcome to our financial planning video. We got something different going on today. My colleague Cory Knott on the screen here has built a comprehensive financial plan for a typical high net worth family in our market. I haven't seen a single number of this plan, and we're going to go through the plan together and how we typically review this with clients, deliver planning considerations and insights, and how we kind of run these types of meetings for the clients that are under our care.
Perfect. Thanks, Tim. I'm going to jump into the assumptions first. So we'll use this to set the stage to give you an idea of the person we're going to be kind of building this plan for. And then once we've done that, we'll jump over into the plan itself. All right. Tim, can you see my screen there?
Yeah, I can see your assumptions page here, and this is a good starting point for the direction we want to take this video today.
Perfect. Okay. So what we're going to be looking at here is an example client. We're going to have Bill here, who's age 56, and Susan, who's age 55. We're going to keep it relatively simple for the purposes of planning, and we're going to assume they're each earning $120,000 a year in salary, so $240,000 combined. That's gross income. They're going to have about $3,000 a month in free cash flow. So that's money that we can use for saving or paying off debt that we can do some planning around. We've built a balanced portfolio, so it's 60% stocks and 40% bonds are what we're using for the assumption. An estimated rate of return is 5.55% annualized. So that estimated rate of return is made up of a few different components. So it comes with an interest component of about 2.57%, dividends of 0.49%, annual capital gains that are being realized of 0.37%, and then deferred growth of 2.12%. So that is like deferred capital gains where we haven't realized it and it continues to grow. And a standard deviation of 10.48%. Tim, were you going to jump in there and say something?
No, I think client profile, it's we always want to understand how the returns are going to be decomposed and delivered to the client. So this is already a little bit more granular than you would typically see in a financial planning engagement, but we like to break this out so that we have a full understanding of what the investment experience, not from just a rate of return perspective, but also potentially a taxation perspective, which will come into play particularly for these folks because they do have non-registered assets here.
Yeah, thanks for pointing that out. And that's really important. So basically, if we all assume this was interest income or, this 5.55% was just deferred capital gains, that will change how the returns will come over a period of time. And then the after-tax returns will be impacted as well. So these components are made up of what we'd expect out of a balanced portfolio. So that's why we see some interest income from the bonds and, deferred growth from the equity component and stock component. And then the standard deviation component would come into play when we run some volatility analysis and stress testing. And basically what that tells us is how much we might expect a portfolio like this to vary from the estimated rate of return.
Yeah,
over
really,
a
really good
year-over-year
points
basis.
There, Cory, because that's a really big component, especially with people who looks like these folks have about less than 5 years until they want to retire. So really understanding that investment experience will provide a lot of insight to that.
Yeah. Okay. Moving on, we've got assumed management fees of about 1.3%. We've got long-term inflation at 2.2, and we're running this plan up until age 90 for both of them. Their asset breakdown, Bill's got some RRSPs of around 1.25 million and a TFSA portfolio of 130,000. Susan's got a RRSP of 850,000 and a TFSA portfolio of 100,000.
Mhm.
And they've got a joint non-registered portfolio with a value of 250,000 and an adjusted cost basis of 200,000. The adjusted cost basis is what is used to calculate the tax outcome. So basically the difference between the adjusted cost basis and the current portfolio value would be their capital gains if they were to liquidate everything.
Mhm.
Okay, moving on, we've got some real estate. They've got their primary residence, which has a market value of 850,000, and we're using an assumed growth rate of 3%. So around inflation plus 1% is generally what we see used for real estate.
And
We've
those come direct from FP Canada, right, Corey?
Yeah, most of our
Yeah.
rates of returns will be coming from FP Canada. Real estate's a little bit of a unique one because it's not a diversified portfolio like it is with our liquid assets where we're holding maybe different types of companies and stocks and bonds all across the world. But we have to use something for real estate. So, it can be a little bit different depending on what city and what town you're in because it's just one individual house. But generally, that 1% plus inflation is what we get from FP Canada.
Yeah. So regional differences, but we use kind of audited numbers from our governing body.
Yeah, exactly.
Yeah. Cool.
So on that primary residence, there is we've got about 250,000 left on the mortgage there at a 4% interest with 10 years left on it, which is about a payment of $2,500.
Mhm.
These clients also have a rental property with a current market value of around $450,000 and a just cost basis of $350,000. So that their difference there would be their capital gain. We don't have an adjusted cost basis on the primary residence because we're assuming that's going to be tax free here in Canada. They've got mortgage debt of $200,000 on the rental property at 4.5%, 15 years left on the amortization, and a payment of just over $1,500 a month. We're also assuming a 3% growth rate, and for simplicity, just for the plan, we're assuming it's about cash flow neutral.
Mhm.
Pensions, we've got OAS and CPP. For OAS, we're going to assume that they're both taking it at 65 with 100% eligibility. We may adjust this when it comes to the plan recommendations but at the base starting point, we're going to use age 65. That works out to around $900 each. And then for CPP, we're going to assume 85% of eligibility, which is around $1,750 each, both starting at age 65.
Mhm.
The financial goals. So, what are we solving for when we're going to build this plan? These clients want a target retirement in 4 years. It'd be 2030, Bill at age 60, and Susan at age 59. So, that's their ideal scenario that we're going to start with.
Mhm.
We can play with that and adjust it and see what things look like. The retirement lifestyle target, they want to spend $150,000 a year, around $12,500 a month, which is going to be fully indexed for inflation. So, that'd be in today's dollars. So by the
Mhm.
time they go to retire, that number is already going to be a little bit different. But
Yeah.
that makes it easy for us to talk about in today's dollars because that's what they're spending today, and it's a little bit easier for them to run those estimates. And then they also have a goal to help out with their grandchild's education and helping fund an RESP for a total of $60,000. So we're going to build that into the plan too and see how that impacts their retirement and what goals they can make. Okay. Any questions, Tim?
No, I'm sure you're going to get into it, Corey, but some of these goals here, we'll be able to model some trade-offs for them depending on the client's preferences for some of the things that they might do. As an example, their their um, desire to potentially get rid of the rental property. That's something that you're going to probably look at. Preferences for adjusting their monthly retirement income, and those types of things. So I'm sure you're going to get into it in the plan. So I'm really excited to see what you've drawn up here on Conquest.
Awesome. Let's do it. I think that gives us a really good starting point to know who we're working with,
Hmm.
and then we can go from there. All right. So we are now in Conquest planning. Tim, can you see my Conquest screen here?
Yeah, perfect. I can see kind of the base plan that you've developed here, and then it looks like you're going to start applying some of the potential strategies to help these folks out.
Yeah, exactly. So this is our software that we use here at North Road. A fantastic tool, super powerful. What we're looking at right now is our central dashboard, and the first graph that we see is our stacked net worth. So we'll kind of be looking at three main charts today just to keep it simple. We'll start with this stacked net worth, and what we're looking at is each column here is a year in time. So we're starting with 2026, 2027, so on and so forth. You can see the client's ages here at the bottom, going all the way to age 90. And then we have certain milestones that you can see. So our current target retirement at age 60, we have OAS and CPP starting at 65. We can see when their mortgage is paid off. We can see where that education goal falls in for their grandson Tommy. We can see when the rental property is meant to be paid. And what we see with these different colors, those are their different asset buckets. So to give you an idea, this dark blue at the bottom here is their primary residence, their lifestyle assets. Then we've got their rental properties. Then we've got their combined registered assets, and we've got TFSAs, and then we've got their non-registered assets. The reason these numbers might be slightly different than the assumptions that we use is it takes the value at the end of each year. So their current primary residence with 3% growth rate based on the end of 2026.
Mm-hmm.
And then we have these values grow through time. So what we can see right now, right off the bat that I can see is our base plan assumes the client makes no changes to their life. They retire, they spend what they want to spend. We've already set those base assumptions. And what I can tell right now is we're going to have a shortfall in funds. And the reason I can tell that is I can see that our liquid assets run out around here, around age 80. So we can see we've used the last of the registered assets. And there's still money or assets left, but it's in their rental property and their primary residence, which is not providing any liquid support or funds to have them spend throughout retirement. So we can see this liability line, which is paid off, now creeps back up because they have shortfalls for these years. So
One thing I've always heard in the past, Corey, is you can't eat a bedroom. So
yeah,
these folks, they're in a situation where they haven't run out of assets in terms of on the fixed side, but potentially without any additional strategies being applied, there's nothing liquid that they can actually spend in order to fund their retirement.
exactly. So then what we're going to do is we're going to run through some strategies, see how we can optimize this and what we can do to get that funded. So two other graphs that we're going to be looking at with our time together. We're going to look at our detailed income. So this shows us our different sources of income and where they're coming from. So you can see for the first few years, it's all earned income from their employment. And that slowly switches over time. And this is really the big question mark where a lot of retirees need help is you go from earning one income or one source into multiple, right? Because now we're going to have things like we've got CPP, we've got OAS, we maybe got rental income, we've got registered income, TFSA income, RIF minimums, non-registered. So all of a sudden the complexity really starts adding up once we get into retirement. And what we can see here is these are our shortfalls once they've started. So we've got income and liquid assets coming in, but around here, around 2052, we start to run into these shortfalls.
Mm-hmm.
So this is another one we're going to spend some time on solving for and optimizing. And the last one is this is a great graph that's going to show us taxes through time. So this red bar at the top is going to show our taxes. What we can see now is it's fairly consistent during their working years, and then it's a little bit lumpier throughout their retirement. So we'll spend some time on this to see if we can organize it a little bit better into something that's a little bit more consistent, but definitely something we want to keep our eye on as we build the plan is where do we see spikes? Where do we see low spots? How do we optimize?
Mm-hmm.
All right, let's jump into it. So we've pre-built some strategies here that I'm going to start running through. We're going to assume that we've already had a really good conversation with the client at this point. I have a little bit of an idea of the direction that they want to go as far as some things that they want to do and may not want to do. So we've built a series of strategies that we can build in. We'd walk through this with the client in real time. We'd turn these strategies off. We're going to see the impacts of them, and hopefully that's going to help them drive a decision on which path they want to take. Okay. Awesome. All right. The very first one that's fairly easy is this client told us, as we saw in the assumptions, they have about $3,000 a month in free cash flow. So the first thing that we're going to look at doing is deploying that money and getting it invested on a regular basis through their last 4 years of their working career. So we can see I can check this box on, and we got get us about a 4% lift to our retirement target. So we saw we're at about 79% funded with some of those shortfalls. Once we start adding some savings, we start getting a little bit of a lift towards their goals. So another way to see this, if we look at their shortfalls, if I turn this back off, you can see we get another 2.5 years of shortfalls that we get covered by adding these savings. So a really good start, some low-hanging fruit. They've got this money they don't really know what to do with. So we're going to start getting that saved and invested. For the purposes of the plan, we're going to be doing $1,000 to each of their RRSPs. and then 500 to their TFSAs. This is a good
500.
starting point to work with. We can offer some flexibility with that. We can have some RSP assets. We can have some TFSA assets. We don't maybe want to go all in on one thing, especially with their level of income. Having both of those pools of money in retirement will add lots of flexibility.
Yeah, pretty close to having those TFSAs maxed, at least for the ongoing annual contributions that they can make. So that's a really good place to start. Is they might have some accumulated room that they can take advantage of, but going forward, any new room that they generate will be covered by that about by that $500 a month. Hey.
Yeah, exactly. And they are in a good spot. Like their taxable income, through income splitting in retirement is going to be lower than where they are now. So the RRSP has a little bit of a better bang for their buck, which is why we're going to do a little bit more there. But we don't want to just totally forgo the TFSA because how flexible it is. And having that as basically a lever account in retirement that you maybe have these chunkier years where you need a new vehicle or you're taking a larger vacation. And if you have to take that all from registered assets, you're going to be bumped up into a higher tax bracket. Having that TFSA as sort of a lever account that we can pull on to keep your taxable income within those thresholds that we want is super, super valuable.
This is real planning being applied. Hey, Corey, to a client situation. It's just understanding how all the different levers that we can pull and when we actually want to engage them and not engage them.
Yeah,
Yeah.
100%.
Yeah.
All right, let's jump on to strategy number 2. So we got a little bit of a lift there that looked really good. The second big strategy that we know after, assuming we've already had a conversation with this client is they told us they're likely going to sell their rental property. As they move into retirement, they're going to be traveling more. They don't want to deal with the tenants. It hasn't been super cash flow positive for them anyway. And it's causing them a few more headaches than they want to deal with. So that's going to be the second piece of strategy that we're going to add here. We've had that built in around age 60 for their retirement. So this is going to give us a nice lift. What we're going to see here is we're going to see a handful of these shortfalls disappear due to having liquid assets and releasing a lot of the equity in the house.
Mm.
And then on the stack net worth, when I turn this off or turn this on, what we're going to see is we're going to see these assets move from the rental property into their liquid assets. So let me turn this on here. As you can see, we've given up that rental property asset and we've moved it over into non-reg.
Mhm.
And our shortfalls are looking much better. We got rid of a few more years here, and things are starting to come together.
Mhm.
Up an important note, when the time comes that they actually sell this property, we would do some planning around where the money actually goes. There's a
Mhm.
chance that, maybe they sell this when they're 59 and they're still working and they have the capital gain to pay on top of their earned income and they have a high tax year. Well, we may shelter some of that in the RRSP and then take it out in a lower tax year in the future, an income split. Maybe it's a TFSA if they sell it in a low tax year during retirement. So we're putting it into a non-reg right now, but when the time comes, there'll be a strategy around what we actually do with it.
Yeah. Corey, any strategy for the cash flow that they get back that they're no longer making payments on that rental mortgage?
Yeah, I mean, depends on when they do it. If it's done in retirement, right, then it's just that much less that we'll need to withdraw from some of their accounts to fund because
Good
their
point.
cash flow needs will be a little bit lower. Yeah. If it happens during their working years and maybe they say, you know what, we actually want to sell us, next year, we know our tenants have moved out, we don't want to, we don't want to replace them, then we may just look at taking that money that was going towards the maintenance and the mortgage payment and maybe increase this $3,000 a month in savings.
Mhm. I think that's a couple key points here to draw attention to for our listeners is financial planning often is a dynamic environment, which is why we really love setting it up with the foundation that we have, like we went over in the initial document. But like you said, client circumstances and decisions can change pretty dramatically and pretty quickly. By setting up the plan as we have today, we can actually help deliver advice to clients if those circumstances change, such as, hey, I don't want to sell my rental property at 60, I want to do it at 55 or 56 or something like that. We have that nimbleness to model that change pretty quickly and deliver high quality advice to benefit those folks that are in that situation.
Yeah, 100%. I think the way we always say, Tim, you and I, is that it's a living document, right?
Yes.
Like we're going to build this roadmap from point A to point B, but it's not going to be a straight line, right? There's going to be pit stops. They're going to go sightseeing. Things are going to change along the way. And each year when we sit down with the client and we review it, great. What did markets return? What are your plans for this year? How are we looking? What's changed? What's not? And we just make these adjustments on the go.
Yeah, really good work, Corey.
All right, let's keep moving. Okay, so these are going to be kind of our two main pieces that we're going to leave throughout the plan and are likely going to stay. The client has already confirmed with us, these are things that they want to do. Now we get into some flexibility and conversation around what do we want to do to fund these last few years of shortfalls.
Mhm.
So the first one, the obvious one, is we delay retirement. These clients are looking at age, their perfect world was at age 60 retirement, 5 years early maybe than standard or expected. But the first thing is, if you want to make this rock solid, the easy answer is we delay this for 3 years. So we can see if we delay retirement here for a few more years. We get a really well-funded plan with a little bit of an overflow, which basically means at age 90 there's still liquid cash available, and we're moving into an overfunded state, which isn't bad. That gives us some room for volatility and maybe spending a little bit more. So this is the first thing that we could say and we could look at. The clients might come to us though and say, we just really want to stay with that age 60 retirement. What else can we do? So this is a possible option, but if we didn't want to go that route, we could turn this back off and we could keep going down the ladder of looking at other alternatives.
Yeah. And Corey, you've built a lot of these plans as well as myself over the years. What's your level of concern with shortfalls that late in the plan? Because there's going to be ongoing planning engagements well in advance of those later years. Talk to me a little bit about your level of concern when you see things like that, or if you take more of the approach like I do, where because these are so far into the future, we're going to have so many opportunities to plan and engage you in ways that we can kind of deliver these recommendations to you. Not as huge a concern when you see it on a big red bar, but not as big a concern that we have to necessarily solve today.
Yeah, and I think in this client's particular situation, something we see a lot of in Canada is a lot of untapped house equity, especially in their primary residence, which usually we don't account for, which is a big fallback, right? So, I mean, we have a few strategies built out later that I'll talk to you about. But for example, we still have their primary residence that even at a 3% growth rate is over $2 million, which is totally untouched.
Mhm.
So, I mean, there's a huge pickup in reverse mortgages and other types of products that can be accessed here or possible downsides, which we'll talk about in a minute. So I do want to build a plan that shows at least that we're on track and we're well funded. I don't want to leave shortfalls necessarily there. And then as things develop, we can make adjustments as we go. But it's very common that we'll see shortfalls, but maybe still have a really large chunk of home equity. And if it's somebody who wants to stay in the home, there's things like the reverse mortgages that can come into conversation or home equity lines of credit and things like that.
Yeah, really good points.
Okay. Okay. So we talked about delaying retirement. They said, let's say pretend the client say, you know what? Okay, it's an option. What else do we got? So let's look at scenario number two. Let's look at maybe working part time for the first 5 years of retirement. So they're earning $120,000 a year now. We see this a lot. Is clients might say, I'll probably retire at 60 if I can. That's great. But I'm a busybody. I can't travel 12 months of the year. I can't sit at home 12 months of the year. I need to do something. I've got this hobby that I'm already doing, or you know what? I still like my job. I just want to do it on a schedule that I can control. So maybe I'll do consulting for 3, 4, 5 months of the year. Things like that we see a ton, and it's a really great way to kind of bridge that gap to still get your early retirement, start getting some of your freedom, but not rely totally on portfolio withdrawals and still keep some income coming in.
Mhm.
So really good option that I like building. Go ahead, Tim. Were you going to say something?
Yeah, just oftentimes, Corey, and you can touch on this too, is as much as we're working around the dollars and cents and the tax planning and all that stuff, we're also touching a lot on that psychological component of retirement, where it's one thing knowing that you can retire and having that confidence to do so, which is what we're trying to accomplish here. But the second facet that often doesn't get discussed as often as we'd like to see is that psychological component of when you retire. A lot of people have that identity that they get from going to work every single day, the people that they get to meet along the way, and those sorts of things. That's going to be gone. That relationship will be severed. So oftentimes, what we've seen is even though people have successfully retired, after a couple of years, as you said, they start getting antsy and start looking for other ways to develop that identity. And one of the ways that you can easily do that is just getting a part-time job, starting at a golf course. I've seen lots of different things where people try and search for the meaning again in their retirement.
Yeah, it's such a good point, and thanks for bringing it up because something we always try to tell people is you really have to think about what you're retiring to,
Mm,
right? So often they have that goalpost in mind, they hit it, and then the after is what comes later is just an afterthought. So spending some time thinking about what we're retiring to really helps with that behavioral switch. And I find doing that part-time work, like you said, almost like helps them ease into it. Right? They start taking a little bit more time off, spending time with the grandkids, but they still get to go to work. They still get to have those relationships, but they can do it on a schedule they can control.
yeah.
And we find that works really well rather than a hard stop. So, okay, let's look at this. So let's say Susan and Bill can each earn $25,000 a year for the first 5 years of retirement. So they ease in at age 60, from age 60 to 65, they're working part-time. They each have the skills that were earning them $120,000 a year. They both agreed earning $25,000 would be really within their ability to do quite easily. So you can see we get a lift on both of these. We can see a 4.9% lift on both these. So Susan starts working for the first 5 years, and we're getting really close now. We just have a little bit of a shortfall if Bill also works for the first 5 years. Well, we've now got a plan that's just over 100% funded, which we can see here. We've got no shortfalls anymore. And if we go look at our net worth, we've got a little bit of cash left over even at age 90. So here's option number two. We've got maybe a delay retirement, or we've got instead work a tiny bit longer, but part-time on a schedule you can control doing the things you want to do.
Yeah. Yeah. Multiple different ways to get to the same objective. Hey, Corey?
Totally. And that's what's so fun about this. This is kind of my favorite you know, part of the plan build is like we've had our initial conversation with the client. We maybe spent 2 to 4 hours together gathering all the information and learning about, their dreams, their career, what they want to do. And then we take all that and we put on all these strategies in based on the things that they've told us, and then being able to review them with them and see it in real time and talk about them. I find this really helps bring it to light where they can see it, where they can see, okay, retiring early, or working later, downsizing, all these different types of things come to light, which is really fun to do.
Hmm. Yeah, I agree. It just getting that insight and getting that confidence from the client perspective is a lot of our a lot of the folks we work with. They know that on some level they're okay, but really getting it to that really clear and clarified way of delivering it to them in a way that they can actually digest and see. Um, I mean, you can touch on that as much as I have, but you see a lot of good feedback and response when you can actually show someone this.
Yeah, right. We just don't want it to be cookie cutter. Everyone's lives are so different. Like we have some clients who just want to keep working. They love their job and they're working until 75. And then we have other clients who want to change something up at age 50. So each scenario is so different. It's not just like, hey, age 65 retirement, do X, Y, Z. You really have to spend the time to look through these custom strategies for each person. And sometimes it's a strategy that they didn't even think about. So a lot of times we add in a few extra that's like, hey, I know we didn't talk about this, but just so you know, here's what that looks like. And then they go, oh man, I didn't think of that. That's actually
Mhm.
really interesting. Let me think about it. And then they'll come back to us and we'll issue a final version of the plan, sometimes with certain strategies that they didn't even come to us thinking about.
Yeah. So pretty high level of confidence with some of the strategies you've applied to this plan thus far. Hey, Corey.
Yeah,
Yeah.
yeah, we've got a couple of options so far, and a few left that we can run through. So we've got delaying retirement as an option. We've got working part time as an option, in addition to downsizing the rental and saving that $3,000 a month. So let's look at another option here. If we turn off the work part time and we go hard stop at age 60, the other option is just reducing our expenses. That's
Hmm.
also another option. And maybe, that 150,000 they gave us, they're saying, it's a possibility that for some clients, they'll come to us and say, you know what, we gave you a number that was a little bit high. We want to play on the safe side. There's a really good chance we're probably actually going to be closer to 120,000, but we want to see what it looks like. So that's an option is, okay, what if we reduce expenses by even 10%? Well, we can see on the stacked net worth that, okay, we've got actually quite a bit of leftover money still by age 90. Our shortfalls are taken care of. So this is another option that could be explored. On the flip side of that, they might say, you know what, we are actually like being pretty safe. 150 is like just on the edge. Maybe it might even be higher. So reducing expenses may not be an option, right? These are the types of conversations that will come up as we explore them. So an easy one to do as far as modeling purposes, but might not fit for every single client. So that is scenario number three. And then we've got one final scenario here, which is downsizing their primary residence. So they're in a house right now, it's $850,000, and maybe, it's 2,000 square feet plus. Keep in mind we're talking Edmonton, Alberta, and Alberta area here. So if
Yeah.
you're somewhere else, you may be thinking, what the heck are you talking about? But yes, you can get a really nice house for 850,000 still in Alberta. So let's say, you know what, at that point, kids are moved out, grandkids aren't coming over as much, or maybe they're spending that time at just their kids' houses. And they say, you know what, I can get a really awesome house for 650,000 even. And so maybe I'll consider downsizing my house. Maybe I go from 850, and after the first 10 years of retirement, we don't want to be cleaning a 2,000 square foot house and dealing with the maintenance, and we're going to downsize to something 600 worth 650,000 and free up that equity. Well, that's a really plausible option too, very realistic for a lot of folks. And that will also provide the shortfall coverage that we need by just freeing up a little bit of the equity where they're still going to own a primary residence. The cost of a home like this is probably still very sufficient for their needs, but now we've got a little bit of extra liquid cash to fund retirement.
Yeah. Yeah, really good options there, Corey. And some of the things that I think you got this foundation set now where we've got kind of three different avenues towards success for these folks. And then once we kind of deliver this plan and start making some decisions around the recommendations that we're making, how do you see the conversation evolving beyond retirement? Do you find that now that they have that level of confidence in terms of their retirement, a couple years goes by, they're drawing their retirement accounts, they're drawing their CPP and all that kind of stuff. How do you see that evolving to something more like a volatility analysis conversation, or even an estate planning conversation? How do you see the evolution of the planning engagement uh, now that we've kind of helped these kind of clients have a really high level of confidence that they can retire when they want to at the incomes that they want?
Yeah, it's a really great question. So the next steps are kind of optimization, right? So we start with building out these scenarios. Once they've decided on a route that we think we want to go in, like let's say we lock in what we have now. Let's say clients go, you know what? This is the version we like the best. We like the idea. We can save $3,000 a month. We can sell the rental property, and there's a very high likelihood that we're going to downsize our home. That gets them to where they need to be, stopping at age 60 without the requirement of working part-time, reducing expenses, or delaying retirement. So let's say they're like, you know what, this is the version we can see ourselves implementing. We'll likely still work part time, but hey, this plan probably supports it without needing it. So the next step, like you mentioned, Tim, at this point, once we've got sort of the framework of what we need and we've got the foundation, we kind of move into the optimization approach, which is okay. Once we've locked this in, how do we really, really crank up the lever on how we withdraw, how we save, and optimize, and then that might fall over into estate, and then also funding kids' education, which was a goal that we talked about, right? So let's do that. So let's take one extra step here and lock in the plan like it is now, and let's do a quick 5 minutes maybe of optimization. So one piece that we would probably start with that we see as a slight lift is delaying CPP to age 70. That's one that, well, it doesn't have a huge lift, only 1.6%. The reason we like it, let me turn this on first and show what it does. As you can see, we get around $80,000 added to the estate and a 2% boost to retirement. But there's some things happening here behind the scenes that we can't see, like you talked about with a volatility analysis or a stress test or a Monte Carlo simulation is also what they're called, is where the plan might not go accordingly as we built it, right? The rates of return and that standard deviation I talked about when we built the assumptions means some years returns might be 15%, some years returns might be minus 10%. The sequence of returns that those come in has an impact. So, what happens when we delay CPP is you get for retirees, they get a larger amount of guaranteed income indexed to inflation, which is
Hmm.
really, really valuable to protect against one, inflation, which is really crucial for retirees as you move on to a fixed income,
Hmm.
uh, a sequence of returns risk. So if you get a bad order of market downturns, you maybe need to rely on your portfolio a little bit less later in your life.
Hmm.
And longevity, if you end up living a longer period of time, having a source of guaranteed income can be really helpful. So for a lot of individuals, as long as longevity is in their future, and then delaying CPP is typically a really smart recommendation to get a higher adjusted base floor of income for a longer period of time. And it really helps when you run those volatility analysis because it's, you rely less on the returns from your portfolio and you shift a little bit of that into a an asset class that is basically a pension, right?
Yeah. Yeah, it's a lot of the trade-offs on shifting risk away from investment risk that you have to incur yourself versus some of these
Yeah.
other pension funds where delaying can often be something that's really, really beneficial to the client when structured properly, planned in advance as well. Hey, Corey, like
Yeah.
we're
Yeah.
planning
Yeah.
these types of things. It looks like, you know, in advance 5 years before they even retire,
Yeah.
right? And that's a permanent decision that we have to think about as well, right? Um,
Yeah. Yeah.
Also, when they're working during, if they're doing that part-time route, right, that's going to impact their CPP benefits slightly as well, correct?
Such a good point. Yeah. Yeah. So all of these things, right, we have to take with a grain of salt where we can map them out, but some of the decisions that they make, year of can change these, right? So the reason why delaying CPP works really well and who it works really well for are those who have the funds to bridge the gap for those
Hmm.
extra years you're delaying. So if they're working part-time, then or we have registered assets or liquid assets that we can withdraw from where they don't need the CPP right away, then those can be scenarios where it can work out really, really well. Not everyone has the ability to do that, but for those that can, it's an awesome way to do it. And the other big bonus about that is, let's say between 65 and 70, you're no longer working, but you have the liquid assets to delay your OAS, or sorry, your CPP. You can pull a little bit more out of your registered accounts at a lower tax rate because you don't have that CPP income also tacked on. So, the most valuable thing about an RRSP is putting it in when you're in a high tax bracket and taking it out in a low tax bracket. You get that deduction difference, and that's really where it's most valuable. So, by delaying CPP, you're reducing how much taxable income is coming into your name, and you may be able to get more money out of your RRSP at lower tax rates. So, you kind of get this compounding benefit if you plan accordingly.
Yeah, yeah, really, really good point too. And then there's also cascading effects on the state potential state tax too, right?
Yeah.
If that terminal tax return on that RSP value, really, really want to pay close attention to if we can get the money out at a lower tax rate, we're actually getting tax benefits down the road as well. On if you have no spousal rollover or anything that you can take advantage of at that point.
100%. And that's a really great point. That's actually what I'm going to jump into last here as the last piece of optimization. Before I do that, there's one other button I want to check off, and then I'm going to come back to that note about optimization and RRSPs because that's a hot topic. So really quickly, let's just look over at the last goal, which is funding Tommy's education here from 2038 to 2042, which they had a goal of, contributing $60,000 to do that. So if I just jump over into the education tab.
Hmm.
Oh, I've got it already turned on. We're lucky. It's already funded.
Yeah, there you go.
So so we're good. So that's great. So one other piece here that we want to see is that if I turn this back off, I had this strategy already set to on, but if I turn it off, you can see a lift in retirement income or retirement funding because we have that extra $60,000 of assets. But what we can see with it turned on, which we could already see was 100% funded, we can actually fund those education costs while still having the retirement that they wanted, which is really an important piece for them is, hey, we really want to help out our kids with our grandkids RESPs and help with the funding, but they want to make sure, can we still live the retirement that we want to live and give at the same time?
Yeah. These people aren't experiencing any threat to their retirement income experience. They can accomplish both goals simultaneously without having to compromise on retirement income or any of those other things that we can achieve both goals simultaneously. So that's a really good spot to be in. Hey.
Yeah, and I think for a lot of folks, it's just the kind of getting that the permission to do that, right? It's like, hey, I want to do this, but like I have no idea what that looks like for me in my life. Running the plan, building that in, and saying, boom, look, here it is. It looks great. Go do it. And they can hand that check over and they're confident in it. It just makes such a difference to have that permission to go out and help the family where they want to.
Yeah.
Okay. Now, last 2 minutes that I want to look at the last little piece of optimization. I mean, we can go really granular, but I'm only gonna kind of scratch the surface here. Is the one thing with the plan that I talked about earlier, and you mentioned a moment ago, Tim, was one is the RRSPs, and then which plays into the tax bill. So as we look at the tax throughout time, our tax bill here, this red line, we can see that it's a little bit lumpy, right? So we've got some consistent tax while they're in their working years. Then we've got no years of tax. Then we've got some lumpiness and then a few more low years later, and then it kind of spikes up. So why is this happening? The reason this is happening is what we see with a lot of folks when it comes to retirement is the software is going to try to withdraw from the lowest tax opportunity on a year by year basis, which might sound good at the time, but might cost you more tax down the road. So how this is happening is if we look at our income and where our income is coming in, you can see for the first few years of retirement, most of the money is coming from TFSAs and non-registered portfolios. So we're experiencing very little tax, which is great at the time, but you're actually usually better off smoothing this tax out. Sorry, let me jump over here over a long period of time because we can still get money out of registered accounts in low tax brackets because if we just push that can down the road, you're going to end up paying more later. So any opportunity that we can get it out in low tax rates, we might want to.
Yeah.
Otherwise, we might end up with something like this, which we're looking at now, is where we have just registered assets later in the year, one pool of money, which
Mhm.
if we have a scenario where we pass away earlier and we have a large amount of money, let's say in this scenario, we have 1.53 million in registered assets at age 85, that would all come out at once to the estate and be taxed at the highest marginal tax rate, which
Yeah.
maybe not ideal. So what can we do about that is we can structure our withdrawals in a different way. So we can pull from different buckets at the same time. We can maybe pull more in certain years that even if we don't need that money to still get some taxable income and get money out of registered accounts, well, it's still in preferable low tax rates. So a
Mhm.
really great way that we can do that is this retirement withdrawal plan that I'm going to check off now that we're really going to see some cool things happen that I want to pay attention to. So when I turn this on, we're going to see some really cool things happen. The first one is you can see the estate went up by $385,000. We did not add any new money. We didn't save any new money. All we did is optimize some of the withdrawals and the order and the accounts that we're going to use. And by that alone, we were able to add close to $400,000 to this family's wealth and to their estate.
Mhm.
And then what we see is more range of colors here, which is basically telling us we have more buckets to withdraw from. So we've got registered accounts now, but we also have some TFSA and some non-registered assets. And as we look closer to age 90, we can see we've depleted the RRSP a little bit earlier, which means we're less likely to have a large estate bill with those registered assets. I mean, if your entire estate is a TFSA and your primary residence, you're in a really great spot because your TFSA is tax-free and your primary residence is tax-free.
Yeah. Just make sure you got a will.
That's right. There we go. So what does this look like? Let's take a look at our income now. So as you can see, our income is much more diversified. You can see we've got multiple colors here because we're pulling from multiple spots at the same time. It's not all TFSAs one year. It's not all registered accounts one year. We're using a combination of those things. We have our taxable withdrawal set to around $77,000, which is keeping us below OAS thresholds as well and any clawbacks, which is really important. And then let's take a look at our taxes. Now we can see a much smoother tax outcome for these clients. It's not nearly as lumpy. We have a higher tax year here, which is likely due to the sale of their rental property. So we may implement some strategies to offset this. But what we're looking at now is a plan that's probably like 90, 95% looking really good. We've got their recommendations. We know the outcomes that they want. We've built in some starting optimization strategies. And then where it goes from here is a year over year by review of what actually happens and how things are going to unfold.
Yeah. Yeah, some really good insight here. This is typically how we run a plan for all of our clients here, Corey. I think the big takeaway here is that when we construct a wealth plan, we don't want it to be a static document, right? We want to have the foundational knowledge and the foundational attributes of a particular client situation so that we can actually model these trade-offs and make recommendations. And then the client has full disclosure on like, this is what it means for their situation. What do you want to do? Right? It's all about making them aware of all the different multiple scenarios that they could experience. We can't plan for everything, but we want to have a really, really good idea of what your future looks like, some of the things that you're considering, so that we can put it into the plan, um, examine it, and make a recommendation that aligns with the goal and your stated objectives. So it's really about having that live framework, right? As your life changes, your finances are going to change as well, and I think that's so valuable to folks to have that kind of dynamic between their planner. That's over and above just what do my investments do, what they look like, and that type of thing. But this more second tier kind of planning consideration that really is valuable to a lot of folks.
Yeah. Yeah, great point, Tim. We really want to spend a lot of time taking a holistic view of everything and making sure we dig in deep to not just the looking at the portfolio, but also all the other aspects that come along with retirement and spending, legacy, and account withdrawals. All it gets complicated fast. So this is a thing that I really enjoy doing. I know you do, Tim, as well. So for anyone watching, thanks for sticking around. I hope it was helpful. We will try to do more of these and implement some more complexity, maybe some corps, maybe some trusts. There's
Mhm.
lots of really cool stuff that we can do here. So if there's anything specific you want to see, feel free to let us know. But thanks for sticking around. And Tim, I think we can call it a wrap there. Hey,
Yeah, really nice work, Corey. Happy to do these videos with you, and I hope the audience have found it as exciting and insightful as we do.
awesome. Thanks, Tim.
Thanks, Corey.